tax year sees the further reduction of the dividend allowance from its currently reduced £1,000 to £500, a pretty low number. You will also be aware, I think, that the dividend tax rates are, as far as we know, ahead of the budget, remaining as they are currently at 8.75%, 33.75% for higher rate taxpayers. That 8.75% rate, of course, is for basic rate taxpayers, and for additional rate taxpayers, that 39.35% tax rate. All of that said, doesn't it make sense, if you can, across the family, to make maximum use of the allowances and lower tax rates that are available to you, if that's practically possible? So if we look at the two main types of dividend income flow, first, the sort of dividend income flow that you can't control the flow of, and that is from your investments, generally, other than investment in your own company, if you own your own company. There, of course, it's very difficult to carry out any last-minute tax planning at the tax year end, as we're approaching it. Thought I'd mention that, because you don't have control over the flow, but you can certainly make sure that 24-25 tax year, the 24-25 tax year, sees you in maybe a better place as a family than you were collectively for this year, by ensuring that the capital asset that produces the dividend, the open-ended investment company shares, the trust, the unit trust units, etc., are owned appropriately, so the income flows to the right people, assuming that that's personally and practically acceptable to you. Making transfers of the appropriate assets to those people ahead of the tax year will ensure that you then have the maximum benefit from that flow into lower tax zones. And of course, the transfer of the asset itself may give rise to a capital gains tax consideration, not if you're making a transfer to a spouse or civil partner. So assuming you could do that, then the income flow through the next year that would have otherwise maybe flowed to an individual, maybe even yourself, that would be taxed at the higher rates, that's 33.75%, 33.75% rate, or the 39.35% tax rate, gets taxed at zero if it falls within the £500 dividend allowance, or at 8.75% if it can fall within the basic rate threshold. So definitely worth considering. Probably not much you can do in this tax year in relation to dividend income from investments, but very possibly something you could do in relation to the next year. So how about those who own their own companies? Well, there you do, on the face of it, have control over the dividend flow, and provided the intended recipient, the lower taxpayer or the zero taxpayer, owns shares, and provided in the case of a spouse those shares are fully participating shares, i.e. not shares that merely confer the right to dividends, then it should be perfectly possible to declare dividends across that share class, with the dividend flowing to the person who owns the shares, and that will be the person who is the lower taxpayer or the zero taxpayer. If you're thinking of doing that in relation to your children, passing shares to your children, then you need to bear carefully in mind the anti-avoidance provisions, the settlement provisions. If the person, the child that becomes the share owner, either directly or as a nominee, is under the age of 18, because it's quite likely then that those dividends will continue to be assessed on you and you will not achieve your tax objectives. So definitely possible in relation to passing shares to a partner, spouse, civil partner. Also possible in relation to children, but bear in mind those anti-avoidance provisions. And if you are passing shares, which would probably be the most obvious consideration, to a lower or non-tax-paying spouse or civil partner, bear in mind that those shares do need to be completely, fully participating. So something to bear in mind as you approach the end of the tax year, and definitely something to bear in mind when you're looking ahead to planning for a great 2024-25 tax year start. All of these strategies are covered in some detail in Tech.